Hello, and welcome to the How to Exit podcast, where we introduce you to a world of small to medium business acquisitions and mergers. We interview business owners, industry leaders, authors, mentors, and other influencers with the sole intent to share with you what it looks like to buy or sell a business. Let's get rolling. And now a moment for our sponsors. I want to highly recommend you get Acquisition Aficionado magazine. Every month, Acquisition Aficionado magazine brings you tactics for business buying and selling you won't find anywhere else. Learn firsthand from industry leaders who share their success stories, featuring in-depth interviews and stories from leading figures in the business acquisition industry. This multi-platform mobile magazine speaks to acquisition entrepreneurs wherever they are in the journey. And I want you to visit acquisitionaficionado.com today. Welcome to the How to Exit podcast. Today I'm here with Steve Conwell. He is with Final Ascent. They do mid-market M&A advisory services, and I'm looking forward to the conversation. Thank you for being on the show today, Steve.
Thanks, Ron. Looking forward to it.
If you've seen the show, you know we always start off with the origin story. I kind of try to drop the joke, but it still pops up. I always like to say, hey, you were born, then you ended up on a show about mergers and acquisitions. Can you fill out the gap in between?
Yeah.
How did you end up here, guy?
Yeah, it's a funny story. So I kind of going back to my audit days with Ernst & Young and going down that path, external audit, IT audit, and internal audit. I was always entrepreneurial. So I built and sold a company with my wife. We had about 90 professionals, and we did recruiting, IT risk consulting for the Fortune 2000. We picked up 7 of the top 10 professional service firms. So we sold it in 2008. And so flash forward, I'm the fractional interim CFO for a residential real estate firm. We built 300 houses. And this exit planning person was a consultant. And I was looking at this going, this is interesting. And as I started to dive into it more, I realized when we sold our company in 2008 and we thought we did great, we probably left easily like $3 million on the table and didn't know. We got purchased by a number 9 firm, thought it was great. We got out in 2008, but I mean, it was a big eye opener for me. And as I started doing more research, I said, this is something that we want to do. So in 2017, we started Final Ascent, doing exit strategy and advisory coaching to help businesses get ready for sale. And so we would refer them out to business brokers and M&A advisors. And we started looking at it and said, at the end of the day, let's see if we can do this in-house. So I brought my friend Jude David, and I started visiting. He's an M&A corporate attorney, M&A advisor. He came on the bus. We brought Chase Kenner in as my other business partner, and then I've been building it out ever since. So we do exit planning, succession, and M&A advisory for the lower middle market.
That's awesome. We were talking beforehand, usually saying your kind of sweet zone is 10 million to like 100 million, right? So for our listeners, most of our listeners are your acquisition entrepreneurs and stuff. We would hope to buy a company, grow it, and need your help to finish the process off and sell it. We're buying that SBA loan qualified, maybe just a little bit, kind of right at the borderline. I think probably our top buyers are buying things in the 8 to 10 million. I say that I know a few people that are bought in the 18 to $20 million valuation range, but it's very rare. They're usually doing, companies doing high 6 figures to 1 to 2 million EBITDA. So, and then the multiples off of that, whatever that happens to be. So our listeners, what we're going to talk about today, I think, is what are you looking for? How do you take them to exit? What's going on in that market space? Because most of our listeners, they want to sell, they want to reach out to you at the end of the process. Okay, I bought this, I grew it, I built it, I've been into it for 5 or 6 years. Now it's time to sell it. I'm willing to, do a process for 2 or 3 years, 5 years, whatever it takes to sell it at its best. Where do we go? So let's start with kind of what's going on in the world today in your realm. So as far as the micro and macroeconomics of mergers and acquisitions of mid-market businesses, what's the space now at the end of 2023 and early 2024?
Yeah, it's a great question. I mean, obviously we got past COVID. And so you had a lot of owners saying, look, let me kind of ride past it for another 2 or 3 years, get my company moving again and building that enterprise value. 2022 was the start of it, a great year. That first and second quarter, still heavy sell side, lots of deals being done. 2021 was gigantic, as you know, I think the biggest acquisition market in history. But what's happened is we've all seen the pain, right? So we've seen grocery bills going up, gas is expensive, inflation, the recession, and now you've got two wars being played out. Hopefully, we'll see the Israel one tamped down soon. But all those macroeconomic effects have started to change the deal market out there. And so you had banks when you had a couple of banks that failed, people kind of getting a little nervous about that, interest rates rising. And so the whole deal community had to sit back and say, how are we going to get these acquisitions over the finish line? How are we going to do it when in the past we were doing, 75% debt, 25% of investment capital and funding? Well, the banks are saying, no, we got to get deposits in. We need to do a 50-50 type arrangement. And so all of these search funds that would go find investment capital after the deal had been signed can't get it over the finish line. At the 50-50% mark, where the only way the banks are going to get comfortable in their due diligence to actually let a deal happen, the multiples have to start to swing down a bit so that
Right.
you can get the enterprise values into this range to say, yes, we can make it happen. So that's what's happening now. Funded buyers, big strategics, private equity groups that have backing. I mean, they're still in the game. There's a lot of dry powder. I mean, tons of dollars on the sidelines that do need to find investment homes, but that's where we're sitting right now. In our experience, we evaluate the market a lot strategically. We're thinking Q1, latest by Q2, it'll start to move. Things will start to tamp down. We've got the December 12th, the Fed is going to be talking. We're all curious to see, are they going to raise rates? They're going to keep it flat, and what are they going to do? But that's kind of what we're seeing out in the marketplace right now. I always say this: good companies in any market will sell. And so when you're building a company, you want to very early in the process start to sell because you're going to transition at some point and at some stage. So start to do your research and understand, like your podcast with all the guests that you have on, what you need to do to build a valuable company that will attract multiple buyers so that you can get that lucrative exit.
Awesome. So what do you think is gonna happen next year? I'll give you kind of a I think historically, if you look at election years, no administration likes to have a bad economy during an election year because it hurts their chances of getting reelected. So they do a lot of things to artificially kind of fix the economy. Maybe it won't stick. I think the Biden administration is going to have to. He's got such a low approval rating. He's going to have to do something. But December is probably the last chance the Fed even has to raise the interest
Mm.
rate again because they're going to be got a
Yeah.
lot of pushback from that point forward. It's going to be we're in once you're in 2024, we're in the election year. People are starting to make voting decisions early on, and I think it'd be a bad idea for the administration to do anything that doesn't boost the economy
Yeah.
and the perception of the consumer. So while they believe raising interest rates slows down inflation, the consumers don't care, right?
Right.
It hurts. So I think December 12th might be they may raise it one more time because I think it might be the last shot at doing it until after the election. So I think there's a sweet spot. What do you think? I mean that I think next year's not going to be a bad year because they're going to fight in tooth and nail the best they can to make the economy good, to make it look good, to make voters comfortable with the administration. And I think that's going to give people that are already in the cycle of thinking of selling an opportunity to get it sold before we're back into a state of uncertainty, right? If the same administration stays in place, which I don't see how they can because the guy needs to retire. That said, the uncertainty after 2024 when 2025 comes around, I think if you got a business you're thinking about selling, it should already be on the market. What's your thought process on like selling something this coming year?
Yeah, I mean, everybody's, waiting with bated breath on who the actual candidates are going to be.
Yeah,
We all believe we're agnostic on evaluating it because we want the best situation for our sellers. So at some stage, we believe, I mean, Biden, it's like we all get older. So at the end of the day, I think that there's going to be a replacement. We're already seeing that. Who's that going to be?
yeah,
We've got some names that have kind of thrown their hats in, but we'll see how that settles in. Once we know, then the market will do its thing. It will settle in and say, okay, now we understand which direction it's going to go. I don't think we're going to see too much craziness in any like tax changes or something that can affect the deal on long-term capital gains. That has been punted for the next administration. But I do believe that you're right. I think we're going to see some games being played on, hey, look how much better it is now. and it's going to be a war. I think it's going to be a war. From the deal perspective, I agree with you 100%. Our experience, what happens, business owners go take a couple weeks off if they can. They see their families over Christmas, the different holidays, and they go, oh my gosh, man, I've been slaving since COVID. I'm tired. My company is doing well. We've been growing. Our net profits are growing in the bottom line. Let's go to market. But as you as I know well, if you wait too long, because it's going to take 8 to 9 months to get a deal done, and you start
Right.
pushing into the holiday season, it could punt into 2025, and you never know what's going to happen. The future you can't predict. As much as you and I are putting our crazy hats on to say this is what we think is going to happen in 2024, China could invade Taiwan,
Yep.
and suddenly all bets are off at that point.
Yeah. There's just so many things uncertain, and that's the economic status right now. It's uncertainty, and it's been that way for a couple of
Yeah.
years. And I don't think that's going to change. Definitely not going to change in the current administration. And it's yet to be seen who wins the election and how that changes. I really hope we get a whole new set. I don't know when we're going to see stability, like like something that's like long and stable again in the current state. So if you're out there, you own a business, and you're like, I'm just waiting until things settle down. You might not retire for 5 or 6 years. You might wanna take a look at what's going on right now and figure out how
Yeah.
to ride the storm and deal with it, all right? 'Cause, I don't think it's gonna settle down for 4 or 5 years, and I'm just guessing here.
I don't think the big thing we watch too is like the debt service on the federal debt.
Mhm.
With the interest rates rising, and you look at that, it's getting close to $1 trillion just in interest every year. At some stage, it gets to where it's too big. And so I think the government's going to have to take a long, hard look at being fiscally responsible. There's a lot of things in the budget that actually aren't, because they're codified in law, that may cost 800-900 billion dollars a year, that is never part of the budget. At some point, I say it this way: you can't run a lemonade stand this way and be 100% upside down all the time. We're a massive cash machine. We have huge receipts that come in every year. So we're not bankrupt by any means at all. And we're the wealthiest country in the world. But at some point, you got to pay the piper. It's like at the end of the day, we're all sitting back in our local communities,
Mhm.
building companies and growing them. You've got families that you're supporting and employees and all that blood, sweat, and tears.
Yep.
And it's like, just stay out of my way.
Yeah.
I want to be happy. I
Yeah.
want to be free. I want to sell it. And it's like my dad says, he goes with his financial manager that he works with. He's always have one question. I'll meet him like once a month. So what are you doing to protect my money from that federal government? You
Exactly.
know,
It
it's just stay out of our way and let us do our thing.
One of my good friends made a point, the other day. He says, "Anytime I have to worry as a business owner about what the federal government is doing and how they're managing things, they're not doing their job. I should
Yeah.
be able to go up, at least in America, I should be able to go about my job on a day-to-day basis, build my company, and yeah, I get taxed, yeah, I get this. There's usually ways I can learn and minimize some of that." He goes, "But to really be concerned should not be something that I have to do." But we haven't been in that way in a while. There's been some concern for a while now. What do you think that the buyers are looking for right now? What are you seeing in the market as far as buyers? Um, I think they're personally, I think they're being more cautious and are looking for things that are stable in any economy. I've seen that at the lower levels, passion industries, things that people send money, whether the economy is good or bad, pet service, veterinarian, health and wellness, things like that. But what are you seeing as far as in that next level up in that mid market? How has the buyer's behavior changed?
It's interesting when you look at the lending, because you always have typically a lending component unless it's an all cash offer.
Right.
The banks are starting to go back to that traditional lending model. So we're not necessarily as comfortable lending on cash flow. We'd love to lend on assets, right? And so you have a lot of buyers, if they got a lot of recurring revenue, where they don't have cash flow concerns, obviously in any market, those are businesses that are great.
Mhm.
But they're looking and saying, okay, if for whatever reason, because something happens with the economy, something blows up, maybe the business has a downturn based on acquisition, can we get our money back? So what we've seen a lot in deal structures, and the buyers are getting more and more aware of this, is the banks are saying, instead of paying me back in 5 or 6 years, can we get paid back sooner? Can we look at excess cash flow and say we want 30% of that coming to us? just to lower the risk of that debt being outstanding. I always say this: if you've got what I define as a great company, meaning that you've got financial statements that are accrual based, you've got your processes documented, the owner has pushed down accountability and authority to his management team and to their employees so that he's got a CEO running the company. Um, they've got a product that's unique in the marketplace, right? So they've got this defendable moat around their competition. They don't have huge customer concentration risk because buyers go, look, I don't want to buy the company and that customer leaves and I'm the big bad gorilla having to go fire people. So what they're doing is they're spending more time on due diligence on the quantitative aspects, right? So they're going to look at the financials, they're going to dive into all the data on due diligence, but they're looking a lot at the qualitative aspects of what impacts value. And they're saying, could that go away? Is there going to be a problem? I think it's gonna tamp down. 2024, we'll see how it goes. I mean, I don't want to throw the crystal ball out there, but I think it will shift and start to shift to where more deals are going to get done. But them being cautious right now, absolutely they are. And I will say for folks like us that represent sellers, we're more cautious on making sure we don't have the wrong buyer. Can this buyer do the deal?
And they
Show
actually
us proof
close.
yeah,
Yeah.
can you close? Show us you can close. Show us that you've got the funding. Show us that, of the deals that you've done, can you do one for this size? Because nobody wants to spend that time 30, 90, 120, 150 days going through this whole process for it to not pan out for
Yeah.
sure.
Yeah, I was talking to somebody who's raising money for a close right now, and he said, "Well, I'm $50,000 within." It's a small business, couple
Yeah.
$1,000,000. He goes, I'm really close." He's reaching out to me. So I'm 50,000. I was like, "No, you're not. You're 250,000." I said, "Why?" And he said, "Because you've got to count for like you've got 3 of your main investors that are putting 200K in. If one of them leaves, so you need 2, like, you have to have a backup because 'cause you're
Yeah.
gonna go to close the way that those small deals are done on closing day, everybody wires their money to the attorney. One
Yep.
guy says, something come up, I can't." You better have somebody else you can call. Like, have at least
Mhm.
one backup, like, especially when you're using only private lenders. If I was on your, advisor stuff and somebody says, I think we raised the money, we're gonna raise another 75,000, like, cool. What's the cap table look like? How many people are you talking to? 5. Ho Okay, how certain you are all 5 are coming to the table?
Right.
Right? Because 'Cause I've seen so many deals, like, I've had people on the show where, "Man, we had one really good, and the day of closing, 150 of my financing backed out." There's a part of me wants to say, "Well, call me when it has that. I'm gonna take a twice as steak what he wanted." Like, there's a way to take advantage of that, but then you
Yeah.
didn't get to it doesn't work because you didn't partake in a lot of the other stuff. Like, you'd be on the fly to get something done in 24 hours or 4 or 5 hours when you didn't have all the due diligence. You don't know what they bring into the table as much as you think you might.
Well, and the other thing too is it's like I always say, well, what's the company worth? Well, it's what they signed the check for, right?
Yeah.
But at the end of the day, when you get that last 2 weeks and it's going back and forth, I mean, we don't say we have a deal done until that cash has showed up in the bank because, buyers can get flaky at the last minute.
Yep.
And you know why? Because they can.
Oh,
We're
yeah.
done, we're out. We're going
Yeah.
somewhere else. And, life comes at you fast. Talk about like stress on a business. So you have a CTO, 10% partner. You have a CEO, 10% partner. You have an investor and his son that own 80%. And in 1 year, not the CEO, but the other 3 people died. Massive stress on, do you have a buy sell agreement? Do you have key man insurance? You're going to have to pay the estate back for all 3 of them all at the same time. You were positioning your company to sell. Well, now, I mean, nobody's going to come in, right? Until this thing stabilizes. And then, God forbid, if the CEO has a divorce situation, something happens to him, economy goes crazy, which it has been. And suddenly, here's somebody who's depending on this business as his major asset to have a multi generational wealth situation completely go away, and the company could sit to where it's not sellable anymore. So, yeah, all this stuff, this happens at any environment. But when people are nervous about making acquisitions, if they're not quite sure they can get them over the finish line, I always say they're looking for a no. How
Yeah.
can I get to a no as fast as I can and politely walk away? They're trying to get to and evaluating that no situation on risk all the way through the deal cycle for sure. And all the other parties are as well right now until things normalize, it gets stable, and they're comfortable again.
I think if it just even with the high interest rates and other stuff going on in the world, if nothing else happens and it stays that way for 3 to 4 months, people start to realize, "Okay, this is just the way it is," and
Yep,
things loosen up. People
correct.
start because people venture capitalists, investors, private equity companies, family offices, they all need to make money. They all need to maintain wealth. They might freeze up when there's a lot of fluctuations, but once they see that it's stable, and even when it's different than it used to be, higher interest rates and
Yeah.
everything else, they come up with a new game plan. Right
Mhm.
now, in the last 6 months, things are changing so fast that they might have pulled back and said, it's hard to come up with a game plan when the and somebody keeps knocking over the whole chessboard every time I set up the pieces, right?
Yeah,
That said, all it takes for money to start moving again, in my experience in the real estate world and business world, is things to maybe not improve, but just stay freaking flat for a while so people can start
stabilized.
you know, they can come up with a new strategy, right? They can come up with a, "Okay, this is the way it is. Here's a new game plan. Here's how we're gonna address this." So that's what we really need on that side, I think.
Plus, a lot of people on these high interest rates, what they're not thinking about is, all right, well, I can get this deal through the cycle. Let's say I take 5% off on the ultimate sales price, but I get cash only. Well, you're sitting in a situation where you can get on a CD 5.3% interest, or on some of these different tax-free alternatives at 4.5,
Mhm.
and dump excess cash just sitting in there. Well, you couldn't do it before when you were at 0.2% interest. So there are like interesting strategies that can be put into play that we haven't seen in a long time, for sellers. The other thing is that I always like to say this. It's a simple statement, but buyers like to buy businesses that are thriving, not surviving. I mean, you
Right.
know that, right? In
Yep.
your world. And because why would they buy some company that's flat? I mean, some like to buy turnaround situations and go that way, but the majority of them, they've built companies. I don't want to go and do a startup, right? And
Exactly.
that's the whole thing. I
I'm
want to
51, I don't wanna do I'm about to turn 52, I don't wanna do that again. The reason I'm in this space is I want to get show me something that's working really well, and it's my job not to
absolutely.
screw it up,
Yeah.
not my job to build it, right? What I wanna that's my going joke is, like, I'm looking for something that's mine to screw up. As long as I don't mess it
Yep.
up, it's gonna crank out cash, that's what I want. I'm not gonna even assume that I can improve upon it. My rule says you don't touch anything for 6 to 10 months, 12 months after you get a hold of it because it's working. Who am I to say that the guy that run it for 30 years didn't know I know so much more than him, that's a bad decision. But, so here I'm trying to think of how to phrase this. I'm just not gonna be nice. If you're out there thinking about selling your business and you're getting worn out, the best thing you could ever do, and I just get so frustrated by this, is go ahead and get a different CEO that's fired up and it starts to grow again. If you're gonna be the guy that's gonna lay back until it sells and tell off, you're gonna have a hard time selling this company. And I see so many small business owners doing this, like, they're ready to sell. You get this scenario, they come back from Christmas, they're either when you come back from a holiday, you're either fired up to go at it again for another year, or
Yep.
a lot of people, they come back and go, "I wanna go spend time with my family," and they kinda kick their feet up a little bit, and they're gonna ride it to close, and that just damages so much because when I look at a company, you start looking at the revenue starting to drop, you're thinking, "Okay, why do I wanna" a plane I don't wanna climb on the plane if it's already in a tailspin,
Yeah.
right?
Yeah. And
Yeah.
well, and you look at it as the buyer's looking at like an iceberg.
Mhm.
So you're presenting all this rosy stuff on due diligence. Look how
Yep.
great we are. They're concerned about what they're not seeing. And if you going through this whole selling process and you're flat, your revenue goes flat, starts to dip, net profits start to dip, buyers start getting concerned. It's like, what am I not seeing? What am I
Mhm.
missing?
Yep.
Now, granted, the reality is they all know buying a company that it's hard, right?
Yep.
It's 24/7. You're trying to keep your company going, hit their goals and objectives while you're answering a gazillion questions on due diligence you thought you'd already answered, right?
Mhm.
So they get that, but they try to use that as an excuse to say, we got to lower the price. We had a quality of earnings report. We evaluated what you've done. Really, you're only worth this. We're going to have to drop it $500,000. The biggest key is when you're not thriving, but when you're thriving, when you're growing, revenue 30% year over year, and you go through the sales process and you maintain that, you have ammunition to say, well, yeah, we can take that $500,000 haircut. But at the end of the day, we've grown consistently. Trailing 12 months is a million five over. So you can pay us the net $1 million. You can have your 500,000 and we'll take our 1,500,000 and call it even. And usually the buyers are kind of, well, you called our bluff. No, we're
Right,
going to
yeah.
keep it the way it is.
But the only way you get to play that card is you're you're
Oh, yeah.
working, you're putting in the time, you're growing, right?
Yeah.
And then, a lot of times they go back and see that and they'll buy at that. They'll either pay what they said before, or a lot of times they'll pay a little bit over because now they see that you are on the right trajectory,
Yeah.
right? I just turned away from a company that they made so many changes. They decided they wanted to sell, but before they did, they changed everything about their company, how they manage people. Like they went from one management structure to like an EOS type of thing, and there was some
Okay. Yep.
discrepancies. And they just changed so much, and then so their revenue went from 2.5 million a year as a small company to about 800K over an 18-month period, and they're starting to climb a little bit back up. But now the other thing that, which is okay, I might oversee that, but
Yeah.
they kept wanting to be evaluated at what they were at the top. Like, "No, that's not how this works. It's
Not
off
how
what
it
you're
works.
doing." Yeah, it's not how
Yeah.
it works. And the second thing is the market on them went from being kinda wide open for them to being highly competitive. There's no barrier to entry in their market space. So when
Yep.
they started the business, they were kind of the only people doing it. There's probably maybe you started getting 1 or 2 competitor. Now they're popping up everywhere.
Oh,
So
tough when that
so now you
happens.
got a very competitive landscape and a declining business, and, like, I was like, "Okay, I have to pass on this." Here's and I wrote him a big long email, like, "This is how you fix it. You gotta carve out a moat, you gotta carve out something so unique in your space that you're known for it. So now you
Yep.
have a different differentiator, you have something that's unique about you, and you gotta get it way back up on the uptick so when, like, an buyer like me or something goes sees that your plan works." Right? All these changes you
Yep.
make, you believe in them. I believe that you believe in them, but I don't believe anything I can't see and see the history of. So you gotta show me where, like, 6 months, 8 months of history of it actually working.
That's what's so tough with sellers, and think, "Hey, I implemented this. Look at all this value I created." But have you operationalize it? Is there proof that it's actually gonna work? The other thing, go back to what you said. So when a buyer asks a seller, "Hey, why are you selling the company?" The last thing they wanna hear is, "I'm so sick of running my business. I'm sick of my employees. I just wanna get out." They're like, "Well, if you hate your company, why am I gonna buy it?"
Yep,
You've got the buyers got to feel like not only you energized and excited, that entrepreneurial spirit that caused you to start the company, build the company, motivate all your employees. They need to feel that. And then they also need to feel options, right? Hey, you could roll over part of this with an earnout, and you're believing in it. We're growing, we're building. You can take
yep,
part in that, or getting a second bite of the apple, selling, rolling over 30% of your equity. They bolt on 10 more companies to yours. It's a platform, sell it again. And now your 30 was worth more than the 70 you sold it for, right?
right.
So, I mean, all this stuff is important. And that's why we say, I hear this time and again, and you made this comment when we first started talking. You want to work with strong advisors as early as possible
Yep,
for the tax minimization strategies, because I can't tell you how sad it is how many times we see millions of dollars left on the table or evaporating,
yep,
or a company like you said in your previous example, they were worth, let's say they were running at 25 million in revenue, they went down to 17, and they dropped down to 10 because of stuff that's happened, and their net profits just dwindled accordingly.
mhm,
They think, well, we still have a $10 million company. The reality is buyers evaluate through history and
mhm,
3-year look backs and all that, and they'll go, something's wrong. Something's much more wrong than we thought. If that was reversed, you would have buyers chomping at the bit to buy that company. I mean, the growth is meteoric, and you'd have a great situation, and I mean, it would sell for huge value. So it's weird. It's like in that scenario where it's growing that much, you get buyers going, "Oh no, we're not going to sell, man. We're rocking. We're blowing up. Let's keep riding the train." And then it drops to zero at some stage. On the other scenario, 25, 17 to 10, it's like when they should be rolling up their sleeves and turning this thing around, we just need to sell. We're tired of it. It's not working. We need to go ahead and get out. And if they just had somebody that could talk to them and help them, look, this is not as dire as you think. And we've got 2 more years. We can get this moving in the right direction, but they leave just an inordinate amount of value on the table. And it's sad.
yeah,
And you have to turn them away. It's like, I'd love to help right now, but you have to sell because your parents just got sick. Life comes at you fast, right?
right.
Issue with your kids, and you have to sell now. I mean, we might be able to get X on it, but the way the market is, it may be very tough in that scenario.
You never wanna be selling on the premise that you can fix something I can't, 'cause, as a buyer myself, I look at it and go, why in the hell do you believe that I can fix something that you've been running this thing for the last 12 years can't fix?
Right.
I'm new.
Right.
I don't care what it is. I don't care if I've done it a bunch of different times. I haven't done it in your business with your employees, with your customers.
Yep.
So that's a new environment to think I can fix something. I love the seller's positive, "Hey, if you do X, Y, and Z, this will happen." It's like, "Cool, why didn't you do it?" I love that seller's encouragement and belief in the buyer, but it's never true. Sometimes our ego says we can, but we won't buy off that premise. It's like the case I was telling you with them, it's like, I can't promise myself and my investors, if I take this to my investors, I can't say with certainty that I'm gonna turn this around in the 3 years. I usually make sure the way our structure is, they get their money back pretty quick. So and then they get to keep a little bit of so it's kind of like a loan with equity.
Yep.
So so I structure it to where they get their capital they put in back pretty quickly, and they end up with a smaller piece of equity than they would if it was just a investment into it. So that said, like to look at my investors in the eye and go, "Yeah, I promise you, I'm positive I can get the money back to you in 3 to 5 years." Like, it's on the decline. How am I gonna promise that? And all the buyers have a story they have to tell somebody. Unless it's a corporate buyer like Microsoft or something like that, it's a strategic purchase.
Yep. Yep. And I think a lot of times sellers, what they forget, almost all cases, the buyers are more sophisticated. They've been there and done that. And
Yeah,
so the reason why I said back a while back about having accrual-based financials is because that's the language of business,
yeah,
right? It's the way that you evaluate your company and compare it to others in your industry, right? So industry benchmarking,
mhm,
but you may not realize they're looking at 200 other companies. So we're going to compare you to companies that are like you, but in different industries, right? Same size, maybe same demographics, et cetera.
yeah.
And you want to present yourself in the best light possible so that they go, yep, I want to pick you. The other tough thing throughout this whole process is that I can't tell you how many times bigger companies, you have a $55 million company, you think everything is great, and you start to evaluate getting prepped to go live and go to market. Accounting is still a mess. 8 months later, it's been completely cleaned up and now we can go to market, but life can come at you fast. So it doesn't matter. You don't need to be, I've got a BSMS in accounting. You don't need to be the expert in it. But what you do need to understand is, how do I evaluate my profit and loss statement? You need to
Mhm.
understand your balance sheet. You need to understand cash flow. Even if you've got advisors who are explaining it to you, or your CPA explains it to you consistently, so you can make effective business decisions. Oftentimes, they're making decisions more on a gut feel versus evaluating, because typically, like, what's happened in the past is a good predictor of the future. And if you've got a runway and projections and all that, you can say, here's how we're driving the ship. Here's our past performance, and we're confident this is how we're going to get there. And then you just get used to doing it, because you go through due diligence and you're selling your company and you get a gazillion questions on the finances, right? I mean, you know the drill, and all this detail, and you're not comfortable with your numbers. And what's happening? Buyers are talking to you. You may have your advisor with you trying to ride herd, but you end up saying the wrong things because you don't understand it well enough. It's not because you're not an expert, it's because you haven't structured your business in a way for success. We see that all the time.
We were talking about you said talking about the accrual accounting basis. I know right now of a tech company who they were in the middle of selling to one of their kind of competitors. It was a strategic purchase, I guess you would say. Company does something similar, wanted to add them as a product line. And it wasn't a small acquisition. It was above 25 million valuation. And they get down to within months of being like they already told a lot of their key employees that they were being sold,
Yeah.
and the buyer had to back out because they figured out the accounting was not accrual and not matching up, and the buyer was going public within a certain period of time, and that would mess up their IPO. The IPO attorneys and accounting departments were saying, like, "Don't acquire that thing. We don't have time to clean that up before your IPO date."
Yeah.
So, it really can mess you up. Like, the one thing that anybody can get right, if you think you're gonna sell in, I'd say in the next 5 years, do a quality design. If you're a company, especially if you're doing 10 million and above and you fit that mid-market thing, bring in accountants, bring in outside people that are familiar with mergers and acquisitions, that know what a deal room looks like, knows what buyers are looking for, accountants and team and advisors that can look at it and go, we need to do X, Y, and Z to make this look right. I just learned recently about this whole QSBS thing. I promise you, I buy the next thing I buy is going to be bought totally different because I want to qualify for that. And if I want to sell it
My
to,
gosh. Yeah.
if I buy something and want to take it to a guy like you and sell it, having the first $10 million be tax-free is pretty, impressive incentive, but it has to be done a very specific way.
Section 1202, yeah, the
Yep,
qualified small business stock.
yep,
My partner, Jude David, he always says this. He goes, do an exit planning in succession and all the tax strategy for selling your company because it's like your will.
yep,
You need to do it, but you keep punting it down the road, right?
yep,
And that it's a 5 year, you have to be change your company's structure to a C Corp
mhm,
and then hold the stock for 5 years or
yep,
more. And
or
if you
more.
do that, you qualify for the $10 million exemption. So it's tax free.
Yeah.
Unbelievable, right?
10,000,000 or 10x your basis. So say you can
Yeah.
prove you put in 2,000,000 or $5,000,000 to build it. If you can prove that's what the insertion was, then you can go 10x that as tax-free. That's incredible.
Unbelievable,
Yeah,
man. I mean, if you just think about the tax savings alone,
yeah.
dropped it into an S&P 500 index for the next 30 years, that alone is multi-generational wealth just on the
It is.
savings. Yeah.
And, like, I'm sure it came up. I brought a tax advisor on a long time ago, but by the time I was in the middle of the show with him, my head was spinning, right? He was in there. I'm sure he spit out the acronym QSBS a few times, and it just went over my head, but I heard about it again recently. I just wrote an article about it, did the research and wrote a small article about it so that other people in this space could be aware of it. What caught my attention is I caught an article where somebody messed it up. They bought a company as a stock purchase instead of an asset purchase,
Yep.
and they tried to do QSBS, and they ended up getting popped because that doesn't qualify. You have to be an asset purchase. There's a
Mhm.
bunch of little things that happen. So if you're an LLC and you're trying to switch over to a C corp, it has to be done very specifically a certain way. You got to set up. I mean, because it's not just a share swap or something like that. It's got to be done by advisors that know how to set it up so that you can qualify on the other end. The cool thing other than that is it's $10 million per tax return. So if you think
Yeah.
about that,
Yep.
I have a wife and 2 kids, right? So think about it. You could set up a C corp, and I've verified this and proved that it works. I could set up a C corp where if I knew I wasn't going to sell, my son's 13, so if I knew I wasn't sell for 8 to 10 years, or even I don't know if it matters if he's a minor when I sell or not, but you could give them a minority stake, get a little piece there, a little. I don't know if I'd give them a full $10 million worth, but you could take the shares and spread among your family and each tax return that you have to file, and including qualified trust.
What you'd have to do, so we would talk about our business owners this way.
Yeah.
So you have like a, say, dad owns the company 100%. He's
Hmm.
got 2 kids. Maybe they're working in the business, maybe they're not. But he's
Hmm.
like, hey, I'm going to transfer some ownership to them, get
Hmm.
them involved in the company. Well, the thing is that those kids make nothing, right? Or even if they're working in the business with a 100K base or something to that effect, you got to pay taxes off that when you're transitioning it. So you have to build this approach to do this over time.
Hmm.
Time is your friend. Time kills deals. Time kills tax advantage. Time kills enterprise value. And so the earlier you can talk and start thinking about this, and most people go, I'm never going to sell my company. At some point, you get a call, which is also a tough, another conversation of getting that call out of the blue and somebody decides they want to buy you. If you're really thinking about selling, go through the process, get multiple buyers to the table, and that person is going to give you their best offer. They weren't when they just called you by
Oh yeah,
themselves,
right.
but they will going through the deal. But yeah, it's just important. It doesn't mean you got to go hire all these advisors, right? But get yourself educated. It's like this. You put your entrepreneurial hats on. Like you said, more about your company in your pinky than I do, even if I got expertise in your industry. But
Hmm.
here's the thing: you wear all these hats, you're an entrepreneur. You need to put a seller hat on and look at your company through the buyer's lens. How do they look at my company? Because then you can take the emotion out of it. Now I can be objective. And
Hmm.
as much as me, like you said, this, well, my company's really worth this, right? 2 years ago it was X, or we're growing like this. So you should pay me all this premium. When you evaluate it from the buyer's lens, you can say, okay, now I understand. Like that commoditized industry where they were the new entrant in the market, and now it's suddenly an army of competition. All right. Well, if you looked at your business when you first started it the way buyers do, and you start the entrance in the market, you would have known I need to find something that's like a blue ocean that makes me unique so
Hmm.
I can maintain my not competitive edge, my valuation edge to my competition.
I love
All of
that
this
phrase.
stuff matters, regardless of industry. All of it matters for
I love
sure.
that. That's the first time I've ever heard anybody call it a valuation. What did you say? Valuation
Valuation
edge.
edge.
Yeah, so instead of competitive edge, what's my valuation edge? What makes me unique in the environment of selling it? And a lot of companies are missing that. That's one of the things I look for when I'm looking at something is what's unique about this that makes them stand out, that'll keep, you know
Yeah,
as these business owners get into this space and they're looking to sell, I love that. What is my valuation advantage? What is my competitive advantage? What is my valuation advantage? It's a good story to tell a buyer. Like,
yeah,
my competitive advantage is this is what makes, and I ask every seller I've ever talked to, I say, what makes you unique in the market space? And a lot of times they don't have a good answer. I'd say majority of
yeah,
the time, probably 80% of them don't have a solid, like, if you talk to a marketing firm, they'll have the answer because they formulate that for other people. But as far as acting, your normal business owner has been around running his company for 30 years, what makes you unique in the market space?
I
You know?
would say that the reason for that oftentimes, it's so simple, but it's not, is when's the last time I always ask them this question, when's the last time you've evaluated your competition and what they are doing? Because sometimes it's their website articulating something better than you, right? Marketing things that you see. Maybe they're hiring people differently. Go on LinkedIn, see their employees and go, wait a minute, what's this title? What's this? What's this?
Yeah.
They don't know. The other thing is a commoditized situation. I like to say, have you saturation proofed your business? Because you may decide it's this time that I want to go to market at the exact same time that your industry is all wanting to sell. And so now it's supply and demand
Yeah.
and just the economics of it. So have you created a valuation edge against your competition and have you saturation proofed your business? Because even if you're a shining star, the multiple will go down if the market is saturated. Because I can go buy this other company that's just like you for the most part for less. So both of those things I think are really important when you put it that way. And as long as you get that education to understand this is how buyers look at my company, and I want to structure my business and my competitive advantage in a way that makes me a shining star. Doesn't matter what the market's going to do, you'll be able to sell for maximum value for sure.
It's funny as I always like to share aha moments, and I just had one when you were talking there. So I manage my business off of 4 questions. 3 I ask during every meeting, and then one of the 4th question I ask probably once every 4 or 5 meetings or once a quarter at least. And I've never thought about having those things, like, pick my top 5 competitors and sign somebody in my team to ask those same questions about those people. And the questions are very simple. What are we doing really well? So we start every meeting off with a pat on our back. What are we doing really well? Right? So I wanna know what's working. So what's working? What are we doing really well? What can we improve upon? Right? What
Yep.
what could we do better? What are we totally missing? That's the 3rd question. Those get asked in every single, whether it's a we're looking at a product or solving a problem.
Yep.
Then once a quarter, I go, what are we doing that we should probably stop? Right? There's
Yep.
something out there. We're spending
Let's
time and
say
energy on
that.
something. We should probably just cut the thing. And
Yep.
I do that when I evaluate businesses. When I'm looking at business, what are they doing really well? Where can they improve upon? Right? What are they totally missing in the market or whatever? And then is what are they doing that I think that they probably just freaking should stop doing what's altogether. It's just wasted their time, energy, and money. And not that I would make those changes right away. It's just something to have in the back of your mind and know so that you can make the changes
Yeah.
when time appropriate. But I never thought about assigning somebody on the team and go, here's our top 5 competitors. Once a quarter, I want this evaluation done on them. What are they doing really well? What could they
Yep.
improve upon? What are they missing? And then translate that into you. Because if they're missing something and you add it to your product, you've got a competitive advantage,
Yep.
right?
And then I would argue probably like once a year,
Hmm.
say you can run a search, top
Hmm.
25 companies in X industry,
Yep.
your industry, right?
Yep.
And then see, okay, these are the top 5 you wanted to do. Well, wow, here's these 2 new entrants
Oh yeah.
that I
Who's
haven't
new?
seen before. And
Yep.
holy cow, man, they're doing something completely different I haven't thought of.
Yep.
So as much as you're doing that due diligence that way, also got to kind of broaden the horizons. Now here's my new 5,
Yep. That's a
you know,
good no,
for
that's a good thing is that the 5 is dynamic. Like this quarter, who are the top 5 this quarter, right? Or this
yep,
once a year at least. I like that. So I'll put that in the in my show notes. Like there's lessons I learned from everything. So apply that to the competitive because that's how you get better. Yeah, the second way you get better is, and we're about to do this for the show and for all my newsletters, is we didn't do it this year, but
yep,
next year, once a quarter, I'm gonna bring in a pool of my listeners and readers, and we're gonna have that meeting. What are we doing really well? What can we do better? What are we totally missing? What do you need that we're not delivering? Right?
yep,
And we take notes on that, and where there's consensus amongst, bring in 10, 20, 30 people on a Zoom call and get those questions answered and document it, you can build something that like the market needs and wants. And that's where I think a lot of companies miss that. And that's I think as you're selling, as you're as an advisor and these people are selling it, you have the unique advantage to bring to the table to these sellers to say, here's what all the buyers want. Here's what you're doing well in their view. Here's what you're doing well. This is what they want this. Here's what you kind of missing there. You're going to want to look for this, and I don't see it. Where is it?
Yeah.
And oh, by the way, you should be really doing this, and you're not doing it at all. And they're going to look. Your business is cyclical. They're going to figure that out in due diligence. You need to do a cash flow, trailing 12 months or the last 3 years of cash flow statements. Be expecting them to want to see the cycle of your business.
Yeah.
But
It's so interesting. It's like trailing 12 analysis. A lot
mhm,
of people will I'm gonna look at my sales this month compared
mhm,
to last year's same month.
mhm,
I'm going to look at sales this month compared to last month.
mhm,
I'm going to do year to date sales compared to budgeted year to date sales. But what they don't do is evaluate their business trailing 12 months of sales. So if I'm looking at January, or like right now is the last day of November. So November, I say I'm going to take my revenue from December 1st of last year to November 30th of this year, all 12 months of it. Then the next month, I'm going to look at my revenue for 12 months, next
mhm,
for 12 months. The beauty of this little simple chart
yep,
is that if that number is bigger than last month's, you're happy. As soon as it goes flat, you're not growing, and we need to go and solve the problem. And you can do this for like cost of goods sold,
yep,
operating expenses. You can do this based on percentages,
yep.
trailing 12 months, gross margin percentage, and compare it month over month.
So I like doing that. I'll look at we always ask for the 3 years financials. If I get all 3 years of financials, I'll actually plot them on a single chart. And
Yep.
I look at revenue and net profits, one of the two I'll look at, and I'll make them like for each year. So I'll do the last 3 years. I'll make them like light red, dark red. So that's that year. So I can tell that dark red is revenue, light red is a net profit for that year. And then on
Yep.
the same chart, on the same like a 12 span chart, I'll do the next year and I'll say light blue, dark blue. And what I'm looking for is if I see on a month-to-month basis charted over 12 months and 3 years stacked, I can see a pattern. And then I can see it's not fully like a cash flow analysis, but I can pretty much see, are there cycles in the business? Are you trending upwards? Are you better than last year? It gets a little confusing, but I don't know if anybody else does it that way, but I like to be able to, and I don't even ask them to do it for me. As long as they give me 3 years financials, I have one of my guys put in a spreadsheet a certain way, and it pops out a chart for me. And it's just something
Yeah.
at a glance, I can look at it and go, you know, there's a cycle here. They are growing over time, and I can see that, but I'm not really good at accounting still. Like even though I had to have it in my undergrad and in my MBA, I still defer that to somebody else. So I have somebody do all that and give me a cash flow analysis. And the first thing I look at it, but a lot of times I don't even know what I'm seeing. I just look at it well enough to go, okay, tell me what I should be seeing here. And I have a few CPA level people that I can reach out to and they can show me and go, hey, I think it looks good. And they go, yeah, this is great. Here's why it's good. Here's why it's bad. We all look at that. A lot of the buyers look at that, and even the small deals all the way up to big deals. And if you as a seller don't take a look at what they're going to look at through their, like you said earlier, looking through the lens of the buyer, you don't know what story you're telling, right?
Yeah. The other concept, it's easier to implement the right things when you're smaller than to try to implement them when you're much bigger. Because I always say this, people hate change. Like even good change is a
Mhm.
beat, right?
Yeah.
And so if you're had your business for 15 years, 20 years, etc., and suddenly you're having to go implement all of this now,
Mhm.
you'd rather take a little bit of a discount, let the next buyers do it because your employees are going to be anxious,
Yep.
nervous, they're going to hate it. And you're going to have all this churn going through a deal process. And there's nothing fun about that, right?
Yep. Somebody said, "Hey, we're closing on this $5 million business or $10 million business, whatever the number is.
Yep.
Here's what I'm gonna change in the first 60 days." And I stop them before they ever say a word. Like,
Yeah.
stop. You don't change anything for the first 60 days. And he says, why? I said, because you're gonna lose the business. I've interviewed 190 people, and every failure I've heard from was I would say 80% of the people that failed after they acquired something was because they jumped in and started making changes. I said, for the first 6 months, 12 months, even 18 months, don't change anything, but keep that list of things you want to change. And I said, no, well, I've got to change things. How do I do it? I said, interview every single person at the company and ask them what they would change if they could. And
Yep.
then compare that to find a consistency. And then when you get consistency of things they would change that match your list, start with those items because now you're changing things they want to change anyway. and you're building rapport with them because it looks like you're listening, and you are listening, but, you start with those things, even if they're the lower level things.
I'd like to say this. This might be interesting. So when a buyer's buying a company, 1A is the company and what you do.
Mhm,
1B is the employees.
mhm.
And the last thing the employees want to do, because the assumption on that scenario where the guy wanted to go make all these changes, what if they've already done a lot of that stuff? So you're going to come in, you're the big buyer. I'm the big new owner now. I'm going to make all these changes to the business. And behind the scenes, that grapevine starts squawking.
Yep,
The person doesn't have a clue. Why did this owner sell the company? This is awful now.
mhm,
And that is so hard to change and get back on track.
yeah,
You're better to do exactly what you said. I love what you said.
yeah,
And then you look like you're wise, you're
mhm,
listening. The other thing is that that concept of the good scenario we just talked about is just be the last to speak. Ask them,
yep,
listen, don't have judgment, and
yep.
then slowly make the changes, and you'll build a much more valuable businesses than you purchased.
A lot of people don't get that. You had to build a rapport with that seller in order to buy your company.
Yep.
Maybe a little less in your market because there's a lot of strategic and capital behind it, but
Yep.
in this smaller market, in that $10 million and below, you'll lose that. You may not win a deal off rapport alone, but you'll 100% lose a deal off rapport. If the business owner doesn't like you, he's not selling to you. That said, sometimes that doesn't happen when the cap table is bigger and you have multiple investors and you can kinda get overrode. The business might sell to the asshole, but excuse my language, but not very in the
Yeah.
lower market, it doesn't happen.
And we sell $5 to $10 million companies too. I
Yep,
mean, we evaluate them.
yeah,
So we're acting like the buyer when we're
yep,
looking at them. The owner may not know that, but we're
mm,
just going, could we get this over the finish line? And it's the same thing. We
yep,
we put the buyer's lens
yep,
on because we know we're going through that cycle for sure.
yep. So, man, I appreciate having you here today. Tell us, what we can do for you. Tell us what's your ideal client, and then how do people reach out to you and get a hold of you?
Yeah, I mean, our ideal client, I mean, if you look at industries, we're fairly industry agnostic, but we're evaluating companies based on the criteria that we've talked about.
Mhm,
Um, we'd like to visit with companies 3 to 5 years early if we can, and then help them maximize that value. What happens a lot is they go, "Oh my gosh, we're running the company like this is great," and suddenly you may realize, "I want to hire the CEO and go down the next path for sure." But if we can visit with them early, if they want to sell now, we'd want to sit down and visit so we can help guide them
mhm,
because maybe that's not the best decision, right? And
right,
we're going to help them. Man, I'll tell you, honesty, integrity, and character matter.
yeah,
I can't tell you how important that is to us. So we will tell you this is your range that you're going to sell for. This is what we're seeing in the marketplace, and we're really going to help you make that decision for sure. As far as getting in touch with me, Steve Conwell, CON is in Nancy, as you can see here. Conwell on LinkedIn, you'll find me under Final Ascent. It'd be a great way to connect. My email address is sconwell@finalascent.com. My direct dial is 214-253-8422 if you just want to reach out and visit. Love to talk to you.
and I'll put his contact information in the show notes. I thank you, Steve, for being here today, and we'll call that
Oh,
a
you're
show.
welcome.
We'll
Yeah,
call that
fantastic. Thanks for talk.
awesome. Hold on for just a second. I want to announce our new channel partners, the ITX Marketplace. Since 1998, ITX has created $5 billion in value by selling more than 225 IT businesses in 20 countries. ITX works exclusively with IT-enabled businesses generating between 5 million and 30 million who are ready to be sold, and M&A decision makers who are ready to buy. For over 25 years, ITX has developed industry knowledge that helps determine whether a seller is a good fit for their buyers before making the match. ITX Mergers and Acquisition Marketplace we have partnered with has a proprietary database of 50,000 plus global buyers seeking IT service firms, managed service providers, Microsoft service providers, software as a service platforms, and channel partners with Microsoft, Oracle, ServiceNow, and the Salesforce space. If you have an IT enabled business you're ready to sell, I want you to visit the itexchangenet.com/marketplace. How to exit. That link will be in the show notes. Visit them now.